Good afternoon again, everyone, and thank you all for attending what I know will be a very interesting discussion on the risks in the global insurance sector. As mentioned, I'm Andrea Mais, Vice Chair of the Executive Committee and Commissioner of Insurance in Connecticut, President of the National Association of Insurance Commissioners. We've got a distinguished panel here. Dieter, who you've already heard from, Dieter Hendrickx from Belgium, will provide some opening remarks. He is the chair of the Macroprudential Committee of the IAIS. We've got Andrea Maechler, who is Deputy General Manager for the Bank for International Settlements. Gita Salden, Executive Board Member of Supervision for, and I'm not even going to try to pronounce this, but it's in the Netherlands Bank. And Nobuyasu Sugimoto, Deputy Division Chief for the International Monetary Fund, and somebody I'm pleased to say, helped the IMF hold its first ever national meeting panel on insurance recently. And Halina von dem Hagen, who's Chief Risk Officer at Manulife. And this panel is going to weigh in on conclusions from the IAIS 2024 Global Monitoring Exercise and what those key risks and trends mean for global insurance supervision. Before we get the panel started, though, I'm going to ask Dieter Hendrickx, who is the head of Prudential Policy Insurance for the National Bank of Belgium and chair of the IAIS Macroprudential Committee, as I mentioned, to join us. And he's going to share the highlights and the macroprudential themes from the 2024 Global Insurance Marketing Report, including key shifts in the life insurance sector. Dieter, couldn't see you, wanted to make sure you were there.
I was trying to hide.
Looking forward to hearing what you want to say. Please go ahead.
Thank you very much, Andy. And also from my side, welcome everyone to the 2024 IAIS Annual Conference. Very happy to be here in sunny Cape Town. It's always good to escape particularly this year, very gray and depressing weather in Brussels, to be honest. So, let's talk about risks again. And before I give the floor back to the panel, I would like to advertise, of course, our Global Insurance Market Report, which we published earlier this week and which will provide you with much more detail into our global assessment of the key risks in the insurance sector than what I will be able to do here in this short amount of time. I would also like to thank very much all those insurers and all the supervisors that participate in the data gathering, because without the data, we cannot perform a good analysis, and better data really lead to a better outcome in this respect. Now, if you look at our 2024 GME, you will see that on aggregate, insurer solvency and profitability remains stable, supported by a strong underwriting performance and robust investment returns. Also, the outlook for the insurance sector, albeit amid an uncertain macroeconomic and geopolitical landscape, still looks robust. We have in our GME also identified two macroprudential themes that remain a priority for insurance supervisors across the globe. A first theme focuses on the key risks in the current, very volatile, very uncertain macroeconomic environment. The second theme, which was already mentioned today, focuses on the structural shifts in the life insurance sector. The first theme really looks into how the sector, the insurance sector, is managing the complexities of fluctuating interest rate while ensuring adequate liquidity to meet obligations and manage credit risks. Key areas of attention from an IAIS perspective are, first of all, surrender risk. Higher interest rates may still lead to increased surrender rates on life insurance products, and policyholders may seek to have better returns elsewhere. Debt sustainability of fixed income assets, our second point of attention. Fixed income assets do continue to dominate insurers' investment portfolios. And although overall the credit quality remains high, historically high corporate and sovereign debt could trigger vulnerabilities. Interest rate changes introduce volatility, and inverted yield curves pose ALM challenges for insurers across the globe. This highlights again the importance of an effective asset liability management. Third risk, risk related to commercial real estate exposures. CRE exposures, although on average still modest, could pose direct risk, for instance impairments, and indirect risk. A downturn in the CRE market can destabilize broader economic sectors, and also the insurance sector may be impacted at that point in time. Fourth item, the impact of derivatives and margin calls. Insurers do use derivatives, mostly to hedge risks, notably interest rate and currency risks, but related margin calls can trigger liquidity risk, especially during periods of high market volatility. Fifth risk, the impact of artificial intelligence and digitalization. Digitalization and AI systems offer potential benefits for insurers, looking, for instance, to streamline their internal processes. However, liquidity risks related to potential easier surrenders in a digital world and risks linked with AI underwriting, asset management, and cyber risk still warrant attention. Last but not least, in our GMAR, we have also examined the transmission channels of geopolitical risk within the insurance sector. Via these transmission channels, geopolitical events can cause market volatility, impacting investment returns, enhance the liquidity and solvency positions of insurers. That can also lead to cyber threats and operational disruptions. We can have impacts on higher claims, particularly for non-life insurance, due to inflation and other related factors. And geopolitical risks ultimately can reduce policyholders' disposable income, potentially increasing lapse rates and lowering demand for insurance products in general. Let's move to our second theme. The second theme focuses on the structural shifts in the life insurance sector. As said before, we cover both the increased investment allocations by insurance to so-called alternative assets and the increased use of cross-border asset-intensive reinsurance. The trend towards higher investment in alternative assets has persisted, despite the higher interest rate environment that we now see in many regions. This indicates that interest rates were not the sole factor driving these developments. Although the overall insurance sector exposure to alternative assets remains limited, some insurers have significantly higher allocations in pursuit of higher yields. These assets, as I said before, they do provide diversification benefits and may enhance the matching of assets to the typically long-term illiquid liabilities of an insurance balance sheet. However, supervisory concerns include discretionary valuation processes, liquidity risks, hidden leverage, and potential credit risks. Last but not least, the use of cross-border asset-intensive reinsurance. Also, this trend is increasing. These agreements transfer both investment and biometric risk associated with long-term life liabilities. Asset-intensive reinsurance transactions are expected to grow, driven by potential factors such as interest rates, credit spreads, pension reforms, and demographic changes. Supervisory concerns include whether these transactions are potentially driven by regulatory differences, concentration risks, both at the jurisdictional but also at the reinsurer level, the increasing complexity of these types of agreements, and potential conflicts of interest. The potential pro-cyclicality of recapture triggers and potential high levels of risk concentration do add a macroprudential dimension to these discussions. So, as said before, we are now in the process of developing an issue paper which will cover these two structural trends, and we hope you will all participate to the consultation of that issue paper that is intended to start in March 2025. I'm going to stop here, Andy, and give you back the floor for the panel.
Thank you, Dieter. We all thank you for your presentation. We appreciate the effort and the global collaboration that it took to create that report. And I'm sure we all look forward to the release of that issues paper. I'm going to start off here by just going to the full panel so they can introduce themselves quickly. And I'm going to start off with the people in the room. And Gita, my apologies for butchering the name of your bank, but I'll give you a chance to clarify that.
De Nederlandsche Bank.
Okay.
Okay. No, we are the insurance supervisor authority in the Netherlands, the prudential insurance supervisor. We have a Twin Peaks model in the Netherlands, so we have also a market conduct supervisor.
Thank you. And Nobuyasu?
Yes. Please call me Nobu Sugimoto from IMF, and I'm in charge of regulation supervision of the financial sectors, and I'm particularly focused on non-bank, which is insurers and asset managers, other securities firms, and some of the fintech firms. And recently, we are also monitoring the pension fund sectors as well.
Thank you. Halina, you're on top on my screen, so you're next.
Thank you. I am Halina van den Hagen. I am Chief Risk Officer of Manulife. That is a global life insurance company headquartered Canada, 500 billion of assets or so. And we have substantial operations in the United States as well as in 13 jurisdictions across Asia. Great pleasure to be here. Thank you.
Thank you. And Andrea?
Hello, everybody. Let me say it's a great pleasure to be here. I'm sorry, my voice disappeared because unfortunately Zurich does not have the nice weather that I heard you have in Cape Town, so you will have to bear with me. My name is Andrea Maechler. I'm the Deputy General Manager of the BIS. So it is a great pleasure for me to be here because we are hosting the IAIS in our building, and that really helps us to really have a good view and good exchanges on global insurance.
Thank you. Welcome all the panelists. And just to let you know in the audience how this is going to go, we're going to have 2 rounds of questions. I'm going to direct one to each panelist per round. But in addition to that, for each round, we're going to have Slido polling questions that we expect you to answer. We won't, tally your individual answers, but we'd like to get an idea of what you're thinking. So before we begin, I'm going to ask the organizers to put the first poll question up so that you can get started on answering that. And while they work on that, 'cause it looks like I might have caught them a little bit unawares, let's see what happens here. I'm going to start with, who do I start with? There are the polling questions, or there is a first polling question. How do you rank the short-term risks faced by the global insurance sector? So if you go on to Slido, put that number in, or if you just scan the QR code, you'll be able to respond and we'll get an idea of what the audience thinks. But I'm going to start with Andrea. And we've got a bunch of risks that are identified: credit risk, interest rate risk, liquidity risk, spillovers from the macro-financial sector, and non-financial risks. How do the risks that Dieter just identified relate to the risks you are observing in the broader monetary and financial system? And what geopolitical risks are relevant to financial stability? How do you see these being managed?
Thank you very much. I must say it was a very good overview of the risk and very similar. That's one of the things. The financial market has become so much more interconnected over the last 10 years. But let me point out a few. So one that was mentioned, and I think it is important to bring it out, is inflation. Right after the bout of very strong inflation we've seen, we are seeing inflation coming down, continuing to come down. And importantly, after the most synchronized monetary policy tightening cycle we've seen in the world, probably ever, at least not for the last 40 years. It is amazing how the global economy continues to really be on broad course for. So these are kind of the positive risks that I would like to point out because they have had a big impact on the financial sector's ability to absorb the changes we've seen in the market. Another one that I want to raise on the short term is there's this gap right now that we seem to see between the relatively low volatility on financial markets and the very strong rise of uncertainty, both in terms of growth outlook and, of course, as we know, geopolitical or even political risk that we're seeing. So right now there's a gap, and it's something really to monitor very closely. More broadly, I want to raise one area that was brought up by Dieter, but the point is, it may not be the short-term risk, but it comes from what are some of the big evolution that has taken place over the last 15 years that we've seen. And one of the things we've seen is a very tremendous growth in financial assets globally. And so that is one change. I think that we tend to forget the level that has grown tremendously. And then the other thing that has changed is the composition who holds these assets, right? We all know it. It's less held predominantly by banks and more by other actors, institutional investors being the key one, of which life insurance play a big role, but of course, investment funds or hedge funds. And the other thing is, of course, with new assets comes also where do you invest those assets, so the search for new markets. And that's really what has been brought up, which is also seen in the investment sector, much more going in new markets, i.e. private markets. Why am I raising this? One of the things that I'm seeing in the risk, and that I would like to highlight a bit stronger than what Dieter said, is what is interesting is the volume of assets has grown, and who holds them, and the dynamic underneath it. But the investable universe hasn't really grown by that much. So the search for diversification continues to be very strong. What am I saying? It's not only geopolitics, right? But it is true. We've seen a big rise in assets, QE being one of them, debt being another one. Sovereign debt has been rising tremendously, and also market and leverage more generally. But for instance, China or India, which are big markets, right? It's not as if so much more foreign investors going in those markets. So the universe continues to be quite concentrated in some, in the US, in Europe, in advanced economies, a little bit in emerging markets. But I think that's where a disconnect can really have an impact. And in particular, in terms of the likelihood of seeing, whenever you see a shock, much higher volatility, much higher reversals of flow, with, of course, the usual impact on FX, on liquidity, that you may see. And I think that is something that we all have to look into. And the last thing I would say is, so we have the possibility or the risk of having much more volatility just because of volume of financial assets moving around in reaction to a shock can be much larger at a time when the system may not be as well able to absorb it. Again, because it's held by different actors that may not have the same capital or liquidity. So in terms of geopolitical risk, I'd simply say for me, it is what has been said. It is also the likelihood that that these assets may have less ability to diversify across markets, across currencies, and that will make it more vulnerable to shock. And of course, cyber risk, which is also clearly a big risk for all actors. I'll stop here. Thank you very much.
Thank you, Andrea. So, Nobu, we've heard, part of the concern is volume, the size of the concentration risk to a certain extent, leading to excessive volatility that may overwhelm the markets and may overwhelm our capacity to cope. Now, this is an insurance meeting, but you're at the IMF, you're looking across the financial sector. You're looking at banking, capital markets, asset management, pension funds. Now, what major risks do you see in the other financial sectors, and how could those risks affect us here in the insurance market?
Yeah. Thank you very much for your question, Commissioner Mais. So before I'm talking about my personal views, let me ask to the audience about which risk do you think is the most referred in the latest GMAs? I'm very curious about the poll question that you already answered, but I haven't seen that. But I counted the GMAs, latest GMAs, the word of how many times they mention about liquidity, how many times they mention about operational risk, how many times they mention about credit risk, and also concentrations.
Well,
and then,
Nobu, perhaps one thing we could do we have the results?
Yeah, that would be great.
We could pull those up if we have them. See, I'm just way ahead of them.
Yeah, maybe I can. Oh, okay. Non-financial risk. Wow, interest rate. Wow, liquidity risk. Okay. So GMAS mentioned 21 times for operational risk, 27 times concentration, 43 times of credit, and then 99 times liquidity. So I prepare my speaking point based on that. So I'm focusing on the liquidity risk, but I'm happy to answer any question that you may have in the end of other risk. So I will probably start from the banking sectors and then go into non-bank sectors such as the capital market, asset managers, and then pension fund, and finally insurance sectors issues. So we published the Global Financial Stability Report in October. and updated our views in the banking sectors. So the banking sectors has remained resilient with capital and liquidity buffer ample and the profitability having improved. So although NPL ratio has risen in some form of lending, such as consumer credit and auto loans and commercial real estate, overall asset quality has not deteriorated significantly. Bank profitability has benefited from higher non-interest incomes, such as fee and commissions, and from measures to reduce operational costs. However, a weak tail of smaller banks face some challenges, and many face challenges related to their business model that result in lower earning and underperformance or undervaluation of their stocks. In some countries, unrealized loss in the securities portfolio and high commercial real estate exposure remain a concern. Now, in terms of the liquidity, we are observing continued reliance of the liquidity provision by banks, even as the size of the funding market has grown significantly in the last few years. This comes at the time when the bank liquidity provision has become more capital constrained. We find this particularly critical in the corporate bond market and short-term funding markets such as CP and CD market, but this may be also relevant in the government bond market. These vulnerabilities are amplified by the concentration of dealers in some of the market, where the small number of core dealers remain that they may not be able to respond to the spike in the liquidity demand in the time of the stress. Having said that, during some of the past stress spike in the liquidity demand in the episode, dealers have also increased their intermediation, but it has proven insufficient to meet the spike in the liquidity demand observed in March 2020 market turmoil. These trends are particularly visible in the advanced economy, but we are also seeing the cross-border spillover to emerging economy who rely on such funding market in advanced countries, for example, for their dollar-based funding. Now, I would like to move to the asset management, which are more linkage to the insurance sector. We are watching carefully the growth of the asset management. For example, bond funds have grown strongly over the past decade, with asset under management increasing sevenfold between 2009 and 2024 in the US market. Holding of US bond among the exchange trend funds and open-ended mutual fund now account for about 25% of the total outstanding, up from about 10% in 2009. So open-ended investment fund, including money market fund, has exposed some vulnerability in the past stress episode, while several measures have been taken at the international and domestic level to mitigate the vulnerability of maturity and liquidity mismatch. We still have a long way to go. We saw this vulnerability play out in several of the past stressed episodes where redemption pressure from such fund transmitted the shock to the core funding market, which were then amplified by the lack of the other investors' pool that could act counter-cyclically. This is a trend which is playing out not only in the advanced country, but also in several emerging economies. Now I'm moving to the private market space. We are also watching carefully the potential liquidity risk. While historically the sector has managed liquidity risk conservatively through mainly closed-end fund structures, they are shifting gradually toward the semi-liquid and open-ended fund structures to attract wider investment pools, targeting to high net worth and other retail investors. So we are seeing some pocket of vulnerability, especially from the liquidity part in some of the sectors, and that may accumulate the liquidity risk through the interconnectedness among the different sectors. Finally, I will mention a little bit about the pension fund and the insurance issues. We are seeing the structure shift in a broad sense in the pension fund and insurer from defined benefit and the guarantee product to defined contribution and the unit-linked type product. While this is a welcome shift from microprudential perspective, from macroprudential point of view, this might create some challenges. The shift effectively means that reduction of effectiveness, effective duration of the insurers and pension fund liabilities, and also reduce both pension fund and insurers the ability to continue to behave counter-cyclical manners. However, on the asset side, we are seeing gradual increase of alternative asset in both the DB and the general account of the life insurers, and also DC and separate account in the life insurers. This might mean that we will not have a counter-cyclical investors in the next crisis. So I will stop here. Thank you.
Thank you, Nobu. Sobering thoughts there. Gita, let me ask you, from your position as an insurance supervisor, you've heard what's been said here. What are you doing in order to help insurers manage their risks as we move forward?
Well, I always ask the question, what is new in this period? And then top of mind at the Dutch Central Bank, but also top of mind at most CEOs in the insurance sector is geopolitical risk. And those geopolitical risks, they translate in traditional risk, credit risk, liquidity risk, capital risk. But what's new is, and I think the outcome of the poll also illustrated that the focus of us on the non-financial risk, on the operational risk. So you can be a highly capitalized company with a good liquidity position, but in this period, the reliance on third-party IT infrastructure is critical. So we published a study on the impact of geopolitical risk on the Dutch financial landscape. I think in Europe we are doing, so what do we do as supervisors? We make more use of instruments like stress test, scenario analysis, and also the awareness to be resilient far more than maybe we place more emphasis on to be resilient. In the European Union, of course, we have DORA, the Operational Resilience Act, which help us identify the critical infrastructure and also manage these risks. So it's not totally new risk, but the emphasis from the traditional financial risk to the more operational risk is something we are very much aware of as supervisors.
Thank you, Gita. And I'm going to turn to you next, Halina. From the flip side of the coin, from the insurer's side, you've just heard how operational risks, non-financial risks are emerging as an even greater threat. And that doesn't mean that financial risks are receding. But how do you as an insurer go about managing those risks?
So I found it both reassuring and a bit surprising how well aligned we are on the identification of top risks, because if you had asked me what's top of my mind, I actually would also answer non-financial risks. And the reason is that financial risks are very important to manage well, but we have been managing them for decades. There are well-established methodologies how to identify, how to measure those risks. There are well-developed market risk mitigation tools that we can deploy in order to contain those risks. So while at the end of the day, one can argue it is about the financial strength and bottom line and the strength of your balance sheet, your profitability, by the same token, we very well understand the framework here, and we have tools at our disposal to manage it. We have been hedging our interest rate risk effectively through a variety of macro and market environments. With respect to liquidity risk, I wanted to make a comment that fundamentally insurance companies, especially life insurance companies, are definitely what we call cash cows, in the sense that we have ongoing very material premium inflows in the cash form. We also hold a very of our balance sheet in undeniably liquid assets, including publicly traded fixed income, often investment grade, most of it in investment grade assets, large holdings of government paper. So structurally, we are cash cow. But while personally I've been paying a lot of attention to the liquidity risk also in my former role as treasurer for Manulife, is the specific form of liquidity that we can be called on to provide in the high interest rate environment, namely cash. And this arises, as the report outlined, from the disintermediation risk in our products, surrenders and lapses. And in this context, absolutely, we need to pay a lot of attention to the product features, contractual, our offerings, as well as to the incentives to the distribution force. So it's on both fronts where we have been tackling the containment of this risk, in addition to having limits in place for this intermediation risk. But also as important, since we all hedge during high interest rate periods, and we tend to hedge a downward risk in our interest rates, we would be called to post collateral on our hedges. And in this respect, and maybe somewhat counterintuitively, I have come to view the over-the-counter arrangements as more stabilizing to overall for liquidity risk management relative to central clearing. The reason is that the central collateral in the form of cash and cash only, whereas in the OTC market, we are free to post collateral in other forms, still highly liquid, like government paper or highly rated corporate bonds, which we typically don't want to sell or dispose of. So having the flexibility to post collateral in this non-cash form, but still very liquid form, has been quite stabilizing in the environment of the rapidly rising interest rates. So I wanted, like we talked a lot about the financial risks and credit risks and high quality portfolios that life insurance companies often hold, and the fact that we stress those risks on the ongoing basis quite comprehensively impacts on our profitability, but also consolidated capital, a local capital, and remittability, liquidity as well. So those risks, again, while very important, are well understood. An additional twist, I think, in the current environment does pertain to the geopolitical risks that we also address through stress testing, tabletop exercises. And one important insight that we gained from this effort was to conclude that actually the geopolitical risk from a financial perspective will impact us to the extent to which they would play through the markets. And as such, they would impact everyone, because sometimes of a focus, or you are in a region X, that's why you could be exposed to those risks more than others. We don't have operations in region Z, so we shouldn't worry, and this is not true. We should worry, each of us globally exposed to global markets, on geopolitical risks, because again, to the extent to which the transmission is through global markets, they will impact us regardless of whether we have operations in a specific region, and hence having robust risk framework for managing financial tools more broadly is essential to contain also the impacts of a geopolitical risk. In terms of the non-financial risks, top of the mind, I also wanted to say provocatively that while cybersecurity is very important, has been for many years now, is well recognized. Again, there is an increasingly well-established framework, for example, from a National Institute of Standards and Technology, with many KRIs, KPIs, through which we can measure the extent of this risk. There have been significant investments from the sector to contain this risk. And hence, while again important, I actually feel quite comfortable, like I don't want to be too reassuring with a broad stroke, as the technology keeps developing and it's also at the disposal of bad agents. But again, this risk is, and I would say, increasingly well managed across the sector. What I pay a lot of attention to is the so-called operational resilience. So while the cybersecurity asks or helps us to prevent someone breaking into the house and then moving freely within the house, the operational asks, in my mind, a somewhat different question, namely, even if I am a fortress house and no one can get in, I am still dependent on third-party providers. And can I keep going if something happens to that third party? And there were a number of incidents in the recent past, the United Health a few months ago, possibly most dramatic, when the inability to keep going had really damaged confidence of customers, tarnished reputation, and resulted in adverse financial impacts. So this focus on operational resilience that IAIS also is engaged in is very meaningful, as it is a risk for the sector. And maybe one more comment. I very much welcome the IAIS approach, open-minded approach, while prudent, adoption of AI, because while we often focus on the risks of doing something, for example, using AI, we sometimes are not as mindful of the fact that there are risks of not doing something. And the world around us is increasingly technologically savvy. Expectations of our stakeholders are aligned with those technological advancements, and we as a sector have to respond to this in a manner that is prudent, but yet we cannot not engage in the progress that's happening in the technology area. So these would be my comments. Thank you.
Thanks, Halina. And as we close, we're going to close our segment, the first segment, on, I guess I'd characterize it as the opportunity cost of staying with the status quo as opposed to engaging with change, though it may be risky. But let's go to round two, and while I start the question, I'm going to ask our team to put up the Slido question. It's audience participation time once more, so please get the Slido question on the screen. And round two, I'm going to ask our panelists to keep their answers to maybe 3 minutes each. I know we're tight on time here because the last panel, we just kept talking. Sorry about that one. But for this round, we've seen the IAIS has identified structural shifts in the life insurance market as a key theme in its 2024 GMAR. There's greater allocation of capital to alternative assets and growing use of cross-border asset-intensive reinsurance. Now, the question that I'd like to think about here is how material are the risks that result from these shifts? So while the audience does this, I'm going to start with Nobu, who's here in the room, and I'm going to ask, what are some of the factors driving that shift towards asset-intensive reinsurance? And from your point of view, what are some of the concerns about financial stability?
Thank you, Commissioner Mais. So I guess the audience answer probably both, so I will talk about both. So we realized these issues around early 2023, and our team, Peter, he may be here, worked very hard to publish one global financial stability note, which is smaller volume of financial stability report in December 2023, focusing on private equity influenced life insurers and their how that their business model is different from traditional life insurers, and which analyzed both the shift of the asset side, increasing investment into the alternative asset, and the substantial shift of the liabilities through the asset-intensive reinsurance. We also covered the trend in April 2024 GFSR chapter focusing on private credit, where the large pension fund and the small number of life insurers are increasing their exposure to private credit and other alternative assets. In the latest GFSR chapter issued in October 2024, we also continue to monitor the investment behaviors of the life insurers with large where the large insurers continue to increase their illiquid asset investment, both with general account and separate account. The reason behind, I think the most important factor is low interest rate environment and search for yield. And why the banks are exiting from some segment due to their tight space of the balance sheet and leverage, traditional life insurers and the defined benefit pension fund have a relatively higher space to absorb both credit and liquidity risk, and therefore it is kind of logical to see that some of the credit risk has been shifted from the banking sectors to insurance and pension fund to some extent. And the regulatory difference among the insurance regulators might have played the important factors behind this shift. Some regulatory environment, higher allocation of the risky asset may allow to apply higher discount rate, which would reduce the variation of the corresponding liabilities. This variation factor tends to be higher than the capital requirement increase when the duration of the underlying liability is longer. I believe the IAIS is analyzing this more closely on this, and so we are actively contributing to the relevant work stream. So the question is, how long will this trend continue? As I mentioned in the first round, both insurers and pension funds are shifting gradually to DC and unit-linked product, as those products often allow some switch of asset allocation between safe asset and risky asset. These products have much lower capacity to absorb less liquid asset and product. To respond to this trend, private credit fund sector is shifting towards semi-liquid structure to attract more funding from wider investors, including high net worth and retail investors. This could bring some difficult challenges to the private credit space on how to address the liquidity needs arising from those investors. They need some redemptions. It's not like insurers and pension who can stick with investment for 30, 40 years. And while industry is trying to address this potential liquidity mismatch by imposing redemption gates and long notice period, however, the effectiveness of those tools are not tested. And the big question mark I have is if they can deploy those tools effectively, especially during the stress period, without creating negative surprise or panic to the retail and high net worth investors. In the private credit chapter of the GFSR, April 2024, we encourage both insurance and security regulators to enhance their cooperation on the information sharing so that each can benefit from their data and the better monitoring of the risk of the sector and the interconnectedness with each other. As IMF is an active member in both IAIS and IOSCO work, we are very happy to liaise and facilitate the coordination between securities and the insurance supervisors. Well, I'm stopping.
Thanks, Nobu. Let me move over to Zurich now. I'm going to ask Andrea, what is your expectation of the changing landscape for alternative assets? I'm presuming you see increased allocation to alternative investments. Am I accurate? And what do you think this will do to ensure investment choices?
Thank you very much. Clearly a very important question. Unfortunately, I don't have a crystal ball. I wish I had. What I can say is you're right. There's been a tremendous move into private markets. And we've done some research that shows what is interesting is how interconnected that move has been with insurance, in particular life insurance. So we've seen so there's a couple of things, and let me then draw some financial stability consideration out of this. The one thing we've definitely seen is life insurance have really gone into more private market, alternative markets. I think Halina said it, they're cash cows, they've had to invest it, and there's been quite a big increase. Now that is not only the end of it. What has been interesting is then, in order to, I assume, economize on capital, they have really partnered up with offshore reinsurance. So much of these portfolios have been shifted under the management of offshore asset-intensive reinsurance. These are usually called AIR, and they're very interesting, right? It brings great diversification for the life insurance. It allows them to go more into diversification in the world that I mentioned. There's not that much or as much diversification as you want, especially low risk. But it does create some risk. And one of them, which is interesting, is that the link hasn't stopped there. These reinsurance are closely linked to private equities. And in fact, if you look at now, these offshore reinsurance, for instance, have been holding. They used to hold, like in the U.S. If I look at, they used to hold less than 15% of life insurance assets, and now they hold up to 40%. So huge increase, and much of it now is held by or acquired by or partnered with private equity. So what we see is suddenly a link between life insurance, reinsurance, and private equity that is it's interesting, but clearly also it adds a tremendous degree of complexity and a tremendous degree of opacity that clearly needs to be monitored very, very closely. So what are some of the risks? So let me just run, because I know we have short of time, so let me respect that. So one, I mentioned it, complexity and opacity is clearly something that I know the IAIS, the FSB are doing quite a bit of work, but more needs to be done there. The other thing is the point that nowadays, if you look at it globally, the life insurance asset ultimately may be backed by less capital and less liquidity and maybe less resilience. Right, so far it has worked beautifully, but because of these complex structure, I mean, that's why they were done. In the end, it is important to figure out the overall resilience. The other thing is clearly concentration, because it is these structures are done in a few jurisdictions, and concentration may really arise. Then another one that I will raise, but it's more specific to private equity, but given the interconnection, it does affect life insurance, are these conflict of interests that can arise unless you have very good governance within these structures. For instance, you may have asset managers that allocate investment funds to assets that they themselves have originated, right? So the private equity originate asset, and then you help them fund assets in those funds. So those are just things that are difficult to figure it out. Often you figure it out, the risk is to figure out it too late, but it is clearly something that needs to be looked at. So from our perspective, it is a trend that is likely to continue, because I think Elena said it, or I believe Dieter, that move was not only driven by low interest rates, it was an important factor, but there are other drivers that make these mechanisms interesting. And I believe an important one is diversification. We just need to make sure that diversification globally is really a true diversification and doesn't end up in a hidden concentration. I'll stop here.
Thank you, Andrea. And Gita, I'm going to turn to you. We've heard an awful lot of concerns expressed, or potential concerns, I should say, on asset-intensive reinsurance. What is your supervisory focus on the reinsurance transactions?
Yes, a good question, and I fully agree with Andrea. It is a trend there to stay, that there is also a link between what we see on alternative assets, on asset reinsurance and private equity into the insurance sector. So the focus is really on, at the end of the day, it is our role as supervisors to make sure that the interest of the policyholder and the stability of the financial system is there to stay. Important things to look at, as already mentioned, is that the alignment of interest, the complexity, how to manage it, do you really understand the transaction, and also, and it was also mentioned in the GMAR, the Global Insurance Market Report, you know, do we understand the motivation behind the transaction, and do we understand the complexity? So our role as supervisor authority is to make sure that the insurer in question really can convince us, can convince the market that the interest of the policyholder is still the primary focus. And in the Netherlands, as of the 1st of January 2025, insurance companies, before entering into an asset reinsurance contract, they will need approval from us. So that is a new requirement. So we are not against it. We just want to make sure we're doing the right thing.
Thank you, Gita. So increased clarity in a certain sense is part of the way that you choose to address this. Thank you. Before, I'm going to come to you in a minute, Halina, but let me just ask for the results of the last Slido poll so we can see what the audience thinks here. And if we could get that up on the screen before I turn it over. So I think as we take a look at this, there is a clear consensus that both alternative assets and asset-intensive reinsurance should receive more focused attention as we move forward.
It's interesting. Also, 11% none.
11% said none. I'm not sure if your mic died, if people could hear you. Yeah, Gita was just pointing out that 11% said neither of those should be the focus of more attention. I'm going to presume who are the ones that are saying that, so we'll go forward from there. But Halina, let me ask you this. You know, again, we've been discussing the risks and the asset-intensive reinsurance transactions. Do you think they've been characterized properly? What do you think they are? Are you comfortable with them? And if not, under what circumstances could you become comfortable with them?
So maybe I start with a little background. In the past 12 months, I've been already in the CRO role, and Manulife did 3 major asset-intensive transactions. In December 23 with Global Atlantic, $13 billion of liabilities, the largest LTC block was within this of $6 billion, the largest LTC reinsurance block. March 24 with RGA, Canadian UL, almost 6 billion. And in December 24, we just announced another transaction with RGA pertaining to LTC and structural settlements. So I'm just like citing it to illustrate that we too believe this market is here to stay, and we actually welcome the developments because there is a new in risk transfer, new capital supporting the risk transfer. It allows us to unlock shareholder value and truly transfer risks from our balance sheet. So how do I get comfortable with the numbers here and the nature of those transactions? First of all, like we ask many of the same questions we risk as supervisors are asking. We are involved from the onset of such transactions. We beefed up resources in risk specifically in order to provide an effective challenge to our business partners and understand the nuances of those transactions and ensure that risks are properly mitigated. We ask about the motivation. Is it aligned with our strategy? And one of our pillars of our strategy is portfolio optimization. Is it aligned with our strategy of de-risking of balance sheet? Is what is left comparable to what we are transferring to ensure there is no cherry picking here? So motivation and analysis of the rationale is very important. But then the critical risk that we focus on is, of course, the counterparty risk. So I quoted Global Atlantic and RGA, both very well established, experienced global entities, strong financials. I read in the report concerns about the reliance on ratings. We normally do our own risk assessment in this regard. We also look at the breadth of an overall relationship with our company because it just helps this alignment of interest if there are other with Manulife. And once we are comfortable with the counterparty, we still are very focused on structural protection through trust. And the trust underpinning, asset trust underpinning the counterparty risk is typically over-collateralized. And we put in place strong investment guidelines pertaining to the average rating of the assets, pertaining to the diversification of assets across sectors, across asset classes, across liquidity, and very important, pertaining to the duration gap with relative to the liability cash flows. So there are top-up provisions typically pertaining to the asset trust and ongoing monitoring to ensure we are comfortable with this protection. There is typically also an option to recapture and take possession of trust collateral assets at Manulife's discretion and based on various triggers that arguably are not like a crisis related only, like they have to do with the strength of the assets, strength of the counterparty, capitalization of the trust. So this is yet another feature of the trust design in addition to the investment guideline that provides comfort with the counterparty risk. We now also have incorporated into our regular stress testing the assessment of recapture risk so that our understanding of financial implications of any stress test include this risk as well. So other assets that, other risks that were top of mind actually was liquidity, because assets being transferred, it is quite common for in reinsurance transactions to give flexibility to reposition assets, give flexibility to the insurer. This also reduces time necessary for due diligence if, for example, in our own portfolio, some of those long-term liabilities are underpinned by alternative assets. So we tend to transfer liquid assets, and as such, we pay attention to the impacts on liquidity metrics and how quickly we will reposition our own portfolio on the liquidity front where our risk appetite is. With respect to regulatory
Halina,
risk,
thank you. I'm going to have to stop you there because this red light is flashing angrily at me and telling me that we're past time. But thank you so much for that. And I want to thank Dieter and the entire panel for their participation and expertise. This has been very lively and enlightening. You know, if you go back to the global marketing exercise, we can see some of the positive issues, the stability of insurers' solvency, profitability. We've seen robust investment returns, but as we've heard here today, there are also issues that we need to deal with. Fluctuating interest rates, managing credit risk, and aside from that, moving out of the financial sector, there are the operational risks, such as AI, digitalization, and of course, geopolitical risk. You know, this was, again, lively, enlightening. Thank you all for being here. Thank you all for attending. Please have a great conference, and please join me in thanking the members of this panel.